Welcome to Market in a Minute. As you know, this is our weekly research piece that we put out. We also have a hard copy, so make sure you get signed up for that. But we do this piece for educational purposes and for our clients as well. And so we want to focus on really what's important in the overall markets and maybe what's ahead of us. So this road to more rate cuts, I love to drive my car on this road. It looks like a lot of fun. So how to play lower rates. This is kind of exciting. So when rates drop, you get nice moves in asset prices so long as the fundamentals are still intact. So we think what's going to happen is we're going to shift back from a late cycle position in the overall economy back to early cycle, where the economy broadens or the stock market broadens out quite a bit. So when to do this and then what to focus on is the key. So a little bit of update on the markets. As you know, we really like this company called Grail. They have a cancer diagnostic. They do it but with a blood test. Over 50 different cancers they can detect. They put out some data over the weekend, which was really compelling, really good. I think they're going to get a priority review from the FDA. It'll get out to the market hopefully by the end of next year. All the data will be coming soon in the first half of 2026. But the data they release, very compelling. This is going to be a really big stock, we think. So what they're doing is they're getting the rubber stamp from the FDA to get the reimbursement from Medicare and broader distribution for the insurance companies as well. But I've been doing it. I highly recommend that you guys take an annual test for this to test for cancer. So Exact Sciences, EXAS, they have a $11.5 billion market cap, where Grail is at 2.8. The potential size of Grail is at least 10x that of Exact Sciences. So lots of room for this stock to run over time. We'll see how it performs in the short term, but again, we're really high on Grail. The technicals of the market. So here's the S&P. You can see that it from October 8th here is pulled back. It came down really close to the 50-day and bounced off of that. Now back to the 20-day. So broke the 20, came to the 50, bounced back. And why is this happening? So what's going on here? So the weakness in the overall market is coming from energy, materials, industrials, a little bit of healthcare. The financials have pulled back a little bit off really good reports. And then tech and the Mag 7 have also pulled back. So what's going on? Volatility is increasing. Volatility is up quite a bit. The VIX index is spiked. So that's a precursor to probably more volatility to come if it stays at this level or goes higher. The strength is in gold. Gold's been strong for a while, so that's really not new news. But staples have been moving up. Utilities, real estate, the REITs, and then healthcare via biotech has been performing nicely as well. So these are more recessionary levels, recessionary groups. So the more economically sensitive stocks have been pulling back a little bit. The less economically sensitive stocks, the safe havens have been performing since October 8th. So not a big trend. So what's going on? First Brands went bankrupt. I think we all probably know that by this point, but First Brands had about $12 billion of debt outstanding. And then a company called Tricolor, also a play on the auto group, went bankrupt. That's about $1 billion in size. So in general, not a lot of debt from these two companies. So very small amount of debt for the financial system, not a big deal. But the fear is there's more to come. And so that's why the financials have pulled back a little bit. And that's why the market's gravitating to groups like the consumer staples stocks themselves. So how big of a deal is it? Well, let's look at the credit spreads. The triple B or double B credit, so just below investment grade, double B and lower have popped. So those credit spreads. So what the credit spreads is you take the yield of a double B bond, you subtract the yield from a treasury bond. That gives you the yield, the spread between the two. So as fear in the economy grows, that spread widens. So we're at roughly 2.8% on October 8th, popped up to about 3.2%. That's a pretty good sized move for that shorter period of time. So that surprised the market. So we'll see if there's any more to follow. Some of the BDCs are seeing some credit issues. So I think that this is an issue worth following, but I don't think a big issue at this point. The consumer looks actually pretty strong at this point, just generally speaking. One other thing to think about of this is that remember the commercial banks having all that real estate exposure in office space. Well, those office loans are coming due. So we might see some more of this occur in that commercial office space. So if you're going to buy a REIT, make sure it's not maybe not levered or have much exposure into the commercial office space in general. How to play falling interest rates. So we think the market's moving to clearly a cut in October. So that's going to come next week. Then a cut in December. And I think now the market's saying, okay, we're going to see a cut in January as well, which makes sense. So the federal funds rate at the upper end of the range is roughly 4.25 right now. And the 2-year Treasury, there's a high correlation between Fed funds rate and the 2-year Treasury, is roughly 3.4. So we think the rates drop down to roughly 3.5%. So that's another cut coming as well. So we're probably going to see an additional cut coming after January to get into that range of 3.25 to 3.5. So what happens when rates fall? Well, generally the rates are falling because we're going into recession or we're in a recession, and basically the economy is getting cleansed out. All the inventories are getting washed out, and the fundamentals aren't good for a lot of companies in that period of time. But right now the fundamentals are okay, and so rates being cut is a nice positive for the overall stock market. So what happens when rates are cut is you get this move to early cycle stocks. So this is where the cutting of rates really helps the business trends of companies that are sensitive to interest rates or sensitive to the economy. So we want to focus on those companies that are economically sensitive and in that early cycle phase of the overall stock market. We don't think that the AI is really going to benefit much from this. That's been chugging along without lower rates, doesn't really impact the AI infrastructure spending at all. But as an example, home builders benefit in a big way. It helps their business, and it helps the business because it becomes more affordable for consumers. So let's look at this a little bit. So we are basically here, right? We're in this late stage of an economic cycle. And back here is early cycle. So we've gone over time, from early to mid to late. What's going on in the late cycle? It's all been AI spending, That's the strength of it all. And so we think that the market will move from basically where we are currently and start to move back to early cycle. This is the part of the cycle where economically sensitive stocks have the best relative performance. So what the Fed's trying to do is keep us out of this recessionary portion here. And granted, they've been slow. It's been really painful for these economically sensitive companies because they haven't benefited from this massive cycle in technology spending, right? The home builders have no exposure to that, and lower interest rates are going to help a lot. Plus, the Federal Reserve is going to lean off the quantitative tightening. That's going to be a big benefit. So what performs in this if this happens? Small caps is where a lot of the action will occur. Small companies benefit greatly from economic expansion and lower interest rates. Biotech really performs well as rates drop. It becomes easier for them to finance their clinical trials. These are long duration assets. And you can see this chart we have here. This is from Fidelity. It shows you what performs well in the early stages of an economic cycle. Financials perform well. Real estate performs well. So if you think about that shopping center, if rates drop, consumers better, the revenues of their customers are better, the cap rates to value the overall real estate drops as well. So very nice for real estate. Consumer discretionary companies. Okay, we don't want to be in the Walmarts and Costco's of the world. Those are more like staples. So we want to be in the specialty retailers. Like Gap stores is probably one of our favorites. So that will perform. That sector should perform really well. Tech still performs well, but what we want to do is focus on the cyclical semiconductor companies that maybe also have some AI exposure to them. Industrials, we want to be in the industrial space, and then reshoring is a secular theme. So a lot of small caps play into this part of the market. Materials, it's in particular the chemical stocks have big upside. So look at this. Look at what doesn't perform well. If we go into recession, it's staples. Staples performed well last week or so. Healthcare performs well. We think the cloud's coming off of healthcare, but healthcare will underperform as the economy really heats up. But we think healthcare will be okay because it's underperformed for the last roughly 5 years. Energy stocks do not perform well in this part of the cycle. And then utilities will not perform well either. So utilities underperform in this as the economy really picks up. But again, there's some AI demand for energy, so they might be okay. In communications, I totally they're going to underperform. But we like Verizon. We think Verizon's turning, and the natural gas group in the energy sector probably be okay because of that AI demand for lots of energy. But in general, energy will underperform the overall markets if we go back to this early cycle and start to take off. So what to invest in as we do this? I'm going to give you some examples. These are not recommendations, but they're examples, and they're on our shopping list. So as an example, Texas Instruments. If we had perfect timing, that'd be great. But we think that the timing is coming into place. So we don't have perfect timing. I don't know exactly where to buy Texas Instruments, but I know we're in the right zip code. So the stock's roughly $176. They report this week. I'm kind of hoping they stubbed their toe, so I get it at a discount. So we have a price target of $276 on this over the next several years. So the lower it goes in the short term, the better it is for the long term. So perfect timing, I don't have, but I know I want to start to really concentrate on these type of investments as rates fall. Now, Texas Instruments, a little bit more detail on that. So their end cycles, end markets are industrials, automotive, personal electronics, all cyclical, right? Less so maybe the industrials because of the reshoring, but these are cyclical markets that they supply into. Texas Instruments is one of the best semiconductor companies out there, really high quality. As the economy improves, this is going to get a lot of benefit from that improvement. So if you look back here, you look at the 12 months of earnings, forward earnings expectations for Texas Instruments, you can see how cyclical this is. So when they get a cycle going, their earnings just rip to the upside. Okay, so this is 2022. expectations were for over $9 in earnings. Now this year they're expected to earn something in the $6 range. So we think over time they could earn as much as $12 in a good cycle. So $12 times stock usually trades around 23 times earnings. $12 from 23 times gives us our price target of 276. Okay, 23 might be off. That might end up being higher. And then the $12 might be off because that might be even higher. So we think that over the next several years, this is going to be a nice mover, and you could probably buy it now. Not sure. Maybe after this week, as a report, maybe we'll get it cheaper. D.R. Horton. Okay, so we've talked about this before. We played this as a trade early in the year. It worked out beautifully. 2020, the earnings went from $4 to $17 in 2022. So that's quite a pickup. So we think that the earnings could probably double off this cycle and maybe a lot more. We know the government wants to stimulate housing. So stimulate housing stimulates the economy quite a bit. And this group has been overly beat up by the Federal Reserve. So we think that earnings from 12 to 24 are very doable. The stock has a very small, a low PE multiple. We think that there's at least a double in the stock over time, if not significantly more, as more stimulus comes into place from the federal government. Now, Floor & Decor. This is one of our favorites. This is a growth company, but it's also very cyclical. It will benefit from what's happening in the housing market. So Floor & Decor, the earnings expectations in 2022 were roughly $1 a share, and then they went to over $3. We think that trend will happen again. We think that if the economy improves, I'm sorry, that's 2020. And then 2022 is what the high was, the $3 per share earnings expectations. So the earnings expectations have come down quite a bit, and we think that they can have a really nice movement, high multiple. So as the earnings come in better over the next several years, that stock could have a really nice increase. Now Dow Chemical. Dow Chemical is deep value. We're talking deep value. Okay, so they already cut their dividend. The dividend yield now, after the cuts, 6.4%. We think that they could go back from earning nothing right now to $8 a share in a few years. So we think that there's 4 to 5 times upside in this name. So you can see very cyclical, right? You can see $8 a share was the earnings expectations here. It's been cut the heck out of, basically down to zero. We think it comes back over time. This may take a bit longer than the others, the three that we talked about, but it has the most upside potential. So these are things to think about. As rates are being cut, the market's going to broaden out. It's going to focus on the more cyclical side of the overall stock market. What does that do to the technology AI trade? Probably just slows the interest down a little bit as you're seeing earnings momentum coming from stocks like Dow Chemical and Texas Instruments, which is not a big play on AI. You know, some of these companies will have very strong earnings growth, maybe comparable to what's happening in the overall mega cap technology stocks currently. So we think the market's going to broaden out and it to be a really interesting period of time as the rates come down quite a bit. So if you have any questions, come to my website, Patrick M. CFA, ping me. Sign up for a hard copy of Market in a Minute as well, and then come to my website where I work, PVG Asset Management, and check out some of our strategies. I think you'll find them really interesting. We do a great job of protecting the downside when it's appropriate, but we get really good returns. Our strategy that's on fire right now is our emerging healthcare strategy, and I mentioned GRAIL being one of our top positions for that strategy as well. Take care.